So we are now starting with economics. Economics initially was so lengthy, it had micro and macro both in detail. Now we have the weightage of 6 to 9%, but there are 8 readings, massive, especially the first couple of readings. And on an average, as you see on the screen, you'll have around 11 to 16 questions. You can expect around 12 to 13 at least. Right? Now, the first topic, which is basically related to the firm and market structure, is actually microeconomics part. Microeconomics talks about the individual business or consumer, and macroeconomic talks about the national economy, the output, the national output, right? So it talks about the whole economy to be, in layman's language. So first we'll discuss firm and market structure, very lengthy. I have tried to compress it as much as I can. However, I still realize that it's still lengthy because I had to cover each and every aspect. Do not expect more than 3 or 4 questions from this topic. Maximum 3, I think so. But still, this topic is very important, even though it's the only single topic in microeconomics. Actually, this topic is a combination of 2 topics put together. Initially, there were these 2 topics that they have combined together, and it's a very lengthy topic. The CFA Institute expects you to know what is demand and supply and what is equilibrium, what is average revenue, what is average cost, what is total cost, what is average cost, what is marginal cost. All of this CFA Institute expects you to know. That's why they have put all of that in the prerequisite. Most of these things I've also covered and I've already uploaded freely on YouTube also, the demand supply in detail, in case if you want to go there and understand the basics. I somehow disagree with the CFA Institute for this part because many of the students are coming from the non-finance background, so they might not have studied that economics in that detail. So I thought that they've done a mistake directly introducing the firm and market structure. However, don't worry, the notes are in such a simple manner that even if you do not know the more in depth about it, I've covered that all in the detail, which you can watch on the YouTube. And here we are going to compress and understand from the exam point of view. I'm going to highlight a lot of things because this is completely theoretical. Many students feel economics is easy to understand, but trust me, my experience says that it is very difficult to score. So even if you might understand everything, when it comes to questions, people make a lot of mistakes. They do not score enough. Yes. Therefore, my suggestion, as I'm going to highlight and make you mark few things, I would expect you all also to do the same thing so that, and even if you don't do it, don't worry, I have bolded all those things. So all those keywords I have, done bold. I've made bold them. So basically you don't have to do it. So your eyes will be only on that, right? Let's start with the first thing, that is firm and market structure. Now, basically, there are 4 forms of market structure. One, broadly, there are 2, perfect and imperfect. Perfect competition and the imperfect has 3 components: monopolistic competition, oligopoly, and monopoly. Now, how do we define these market structures? These market structures are based on some aspects, some factors. For example, the number of players and the relative size of each company is producing, right? Then the degree of product differentiation. Are they all producing the same product or different product? The power of the seller, the pricing power of the seller basically, and the relative strength of the barriers. There should be enough barriers to enter and exit for the company to dominate this particular sector or industry. And the degree of non-price competition. Is the competition only about price or beyond that also? Is there competition based on quality or based on variety, right? Now, let us understand the basic difference between all 5. I'll highlight you some of them, which many of you all must have already been aware of. So, from perfect competition, as you move to monopolistic, oligopoly, and monopoly, what happens? The number of sellers in that particular product keeps on decreasing. Perfect competition has many firms producing the same product, but monopolistic, relatively less firms than perfect competition. Of course, there are many firms, but they are also producing same, slightly different product. Now, the best example of perfect competition, which I give many of my students, is a retail shop, which is called a kirana shop or bakala in UAE. Now, here, many firms are producing or supplying the same product. So the barriers to entry are low. In monopolistic competition, the product is slightly differentiated, like a toothpaste. So they all are doing the same thing, but the product is slightly differentiated. We buy that product because of the feature that they probably show us. Now, oligopoly, there are very few firms, majorly 3-4 firms maximum. They all might be producing either identical or differentiated products. So the product nature of the product here can be anything. Monopoly is single firm and there is no substitute available. Understood? When it comes to barriers to entry, as you see, as you move from perfect competition to monopoly, the barriers keeps on increasing, and it is the highest in monopoly because there's only single seller here. The most important thing is that the demand curves. See, demand curve is generally downward sloping, means at higher and higher price, the demand will be decreasing, correct? The demand will keep on decreasing at higher and higher price. In case of horizontal, in case of perfect competition, the demand curve is horizontal, means the demand curve is perfectly elastic. Perfectly elastic means even a smallest change in the price will take away the entire demand away from the company which increases the price, isn't it? But that's what happens in an identical product market. No one dares to increase or decrease the price. The price generally, especially increase the price, because if you increase the price, you'll move, because all the companies are selling the same product. Then what happens because of this? Your entire revenue will be lost. So in this case, the demand curve, which we'll see later in the perfect competition, is perfectly horizontal, right? But in all the other cases, the demand curve is downward sloping. What does it mean? It means a very crucial thing, that as the price will keep on increasing, whatever type of the market it is, even if it is monopoly, what will happen? The demand will keep going down, right? Now, nature of competition, in perfect competition, it is only related to price, but in monopolistic competition, it is related to price and the marketing feature which the company is trying to promote. For example, they might say that my toothpaste has more refreshness than the other toothpaste, etc. Correct? Same goes with the oligopoly. Oligopoly also has a price and marketing feature, but monopoly has only on the basis of advertising. Yes, they do advertising even though they are monopoly. Pricing power, in perfect competition, there is no price power. Remember the keyword here. In perfect competition, firms are said to be price takers. They take whatever the price is available, but on the extreme side in monopoly, they are said to be the one who make the price. They are the price makers. Correct, everyone? In monopoly, the objective is to maximize profit and not price. Keep that in mind. The objective is to maximize profit, not the price. We'll discuss more about that in detail. When it comes to monopolistic competition, there is some pricing power, and in oligopoly, the prices power can be significant, but it depends whether the firms are able to join hands together. That is what they are making cartel, which we'll call as collusion, right? Companies set their own prices and make abnormal profits in the long run. Now, you will notice this abnormal profit part is only present in oligopoly and monopoly. There is a possibility of making abnormal profits. Now, first of all, when I say abnormal profit in economics, what is abnormal profit? So in economics, we have economic cost. Economic cost. Economic cost includes your accounting cost plus opportunity cost. Understood? And so from the total revenue, when I subtract my economic cost, I get my economic profit. Everyone. Now, if you are making more than this point, if your total revenue is more than the economic cost, then the profit that we make is called abnormal profit. I'll repeat. If the total revenue is more than the economic cost, which also includes the opportunity cost, then we are making economic profit, which is here the abnormal profit. Understood? The best example here, wheat, or you can say bakala, toothpaste, automobile or airline are very tight industry. There are relatively less players. And generally the power distribution in a specific country or state is dominated by a single firm. So that's what the perfect example of monopolies. Now, that was the basics. Now we'll go in detail of each of the segments. Especially we'll start first with perfect competition, and then gradually we'll move to the other forms of competition, right? Perfect competition is where major focus is. Now in perfect competition, first of all, When should a firm decide to continue to operate or shut down? This is one of the most important thing and which they frequently ask. Now, before I even begin, let me discuss what is average revenue, what is average variable cost, and average total cost. First of all, total cost of a company includes total fixed cost plus total variable cost. And when I divide these costs by the related quantity, it becomes average total cost, average variable cost, and average fixed cost. Average revenue is total revenue divided by the quantity. Now, whenever a firm's average revenue is below the average variable cost, the firm is not even able to make up enough revenue to cover its average variable cost in the short run, it should immediately shut down. This point is called short run shutdown point. Means you're not even recovering your variable cost, shut down immediately. But in the long run, see, in the short run, you might just cover sometimes variable cost, but to cover the fixed cost, it will take much more time. So to cover the overall total cost, you need to also cover the fixed cost. At some point of time, you should be able to cover the average total cost. If the firm's revenue are not, its average revenue are not even covering the average total cost in the long run, in short run, of course, it might take time. No company or no firm is in the position to cover all its costs from day one. But in the long run, if the company is not able to cover its average total cost, then the firm should shut down in the long run. This is called long run shutdown point. So short run shutdown point is when the average revenue is below average variable cost. Long run shutdown point is when the average revenue is below the average total cost. Correct? Now, when we go in more detail, when the firm covers average revenue is enough that it covers the average total cost. Now here, when I say average total cost, means it includes the accounting as well as opportunity cost, right? So it covers the economic cost. So when the firm's revenue or average revenue are enough to cover average total cost, we say the firm's economic cost, total revenue is equal to total economic cost, and that is the break-even point. If the average revenue are more than that, then we say you have been making economic profits. So what is the break-even point? Break-even point is the point where the average revenue is equal to ATC. Correct? If the average revenue is greater than ATC, yes, then the firm should continue to be in the business in short run and long run. There's no harm. But now see an interesting thing. If the average revenue is greater than average variable cost, should I continue being in the business? Yes, for short run, you can continue. But if the average revenue is below ATC, above variable cost, but below ATC, then in the short run, you can continue. But in the long run, if you are still below ATC, you should shut down or exit the market. Understood, everyone? This is the most crucial. Which is the most crucial? The third part. When average revenue is between variable cost, average variable cost, and average total cost, then in the short run, you can continue. In the long run, you should shut down. Is that clear, everyone? Correct? So basically, what we understood, the short run and long run decisions, correct? So if the total revenue is equal to total cost, everyone in the class, total revenue is equal to total cost. Should I continue doing the business? Yes, I'll be staying in the business in the short run or long term. But if the total revenue is greater than variable, but below total cost, in the short run, you can continue. But in the long run, you cannot survive without covering your total cost. And in the long run, you should exit the market or shut down. And if your total revenue is below total variable cost, there's no point continuing the business. It's better to shut down rather than continue even in the short run. Understood, everyone? This, as per me, is one of the most crucial things and very frequently asked in exam. We will also see some of the questions, but there are surely going to be questions related to this shutdown point. Everyone with me? Clear? Yes. Now we are going to understand an important concept that is called economies and diseconomies of scale. See, most of the companies, if they are producing at a massive scale, their average fixed cost will keep coming down. Average. Due to this, their average total cost also goes down. Why? Because the fixed costs are fixed irrespective of the quantity that you generate, right? So in the long run, if the company is being operating efficiently, what will happen? What will happen? we will see the company's average total cost keep going down. Now, this short-run average total cost over the company's different plant sizes and scales of operation, when I plot the different short-run ATCs, it becomes a U-shaped long-run ATC curve. Different short-run ATC curves, if we plot them over the different sizes of the companies and different scale of operations, different quantity of production, then what we get is long-run ATC curve or long-run average cost curve. Now, what is unique thing about this? That this tells us that the point where the ATC is minimum, let's say this point is where the ATC is minimum. This point is called minimum efficient scale. Everyone in the class, it is called minimum efficient scale. This is the quantity. This is the point of quantity. This is basically the number of units over the time. And this is the revenue. So you should, this is basically the cost. Okay, in dollar per unit, this is the cost. Now, this is ATC. This is my quantity. Now, what do you notice, friends? As you keep on more and more producing, the average total cost initially is going down. So this point on the left side of minimum efficient scale is called economies of scale. Why? Because what do you notice? ATC here is average total cost is increasing or decreasing, everyone in the class? As you keep on producing more and more, what do you notice? The average total cost is going down. Are you with me? Correct? This is called economies of scale. Economies of scale generally happens because if you're producing at a massive scale, you get labor specialization, mass production reduces your cost, and investment in more efficient equipment and technology. Right? This is a downward sloping segment of long run ATC. So this is the downward part of long run ATC. This is called economies of scale. What happens in economies of scale? Average total cost is going down, right? And then it reaches to the bottom. So this is the point where ATC is minimum. This is the point where you get the lowest average total cost. So this is the point of maximum profit, right? Everyone in the class? So you should keep on producing till the point where your ATC keeps going down and it reaches to the lowest point, that is called minimum efficient scale. Beyond this, what will happen? Beyond this, you will get diseconomies of scale. Diseconomies of scale basically is a point where the ATC starts increasing. Yes. And why does a company face diseconomies of scale? Because first of all, this is the upward sloping part of the long run ATC curve. And this happens because when a company becomes too much big in size, the decision making slows down, increasing bureaucracy, problems of inefficiency, a lot of overstaffing, right? No enough motivation for the workforce, because you see large companies, files move from one point to another point. It takes a lot of time, right? And there are great barriers to innovation and entrepreneurial activity. They're mostly following the same process. This is the point. Even if you produce more, your ATC is not reducing, your ATC is increasing. This is called diseconomies of scale. Everyone with me? Right? So, many people tell me that why China is being able to produce the cheapest cost, because it is having economies of scale. The more and more it produces, its cost per unit is going down. That is called economies of scale. But if over the longer period, many companies, many large companies, especially government companies, the decision-making process becomes too slow. So then they face diseconomies of scale. And between this both phase, for a temporary moment, you have this straightforward line, which is called constant returns to scale. What happens at constant returns to scale? There may be a relatively flat portion at the bottom that exhibits constant return to scale. Over a range of constant return to scale, costs are constant. So your ATC is constant for different plant size. Everyone understood economies, diseconomies of scale? Check in the class. So we will produce till the point where the ATC is minimum, and that is called minimum efficient scale. Please confirm me if you have understood till this point. Right? We'll see a couple of questions based on this. Okay, clear? Okay. Now we will go into detail of each of the structures of market, beginning with perfect competition. Then we will discuss monopolistic competition. But the most important part that I've noticed from the exam point of view is the comparison of both. So I'll focus on the key things. Many of the things we've already discussed, but then the comparison of both is very crucial. First of all, perfect competition is the only one where, if you notice, if I put here price and quantity, normally the demand curve is downward sloping. It's only perfect competition where the demand curve is a horizontal line, which is highly elastic, perfectly elastic. So here the price equals to demand equals to MC equals to MR, marginal cost or marginal revenue, everything is the same. So here price, marginal revenue, average revenue, everything has the same point. And one very, very, very important highlighted thing here for your reference is that a profit maximizing firm, for any firm who wants to maximize their profit, they should produce at a point where MC equals to MR. Now, this is the most important line in your entire economics, especially this topic. Now, this line, a profit maximizing firm will produce till the point where MC, marginal cost equals to marginal revenue. That is where the profit is maximum. Now, guys, please remember, this is this point which I have mentioned here. It is the same for perfect competition as well as imperfect, whether it is monopoly, oligopoly, or monopoly. So in exam, they say a profit maximizing firm will produce the quantity where MC equals to MR. This applies for monopoly, oligopoly, perfect competition, or monopolistic, any form of market structure. This rule applies. Have you highlighted this? This particular line has the highest chance of asked in exam. In fact, if you've solved many questions, you might have seen this asked many times. Understood, everyone? Right? Now, what is the equilibrium in perfectly competitive market? First of all, firm will not earn economic profits. Why? Because this market is barrier free. Anyone can enter or exit. So if there are economic profits, new firms will enter the industry and that economic profit will disappear, right? So the price will be equal to average total cost only. And also on the other side, if the prices are below, if there are losses, many firms will exit the market because there are no barriers to exit also. Due to this, the market will always be at the equilibrium where the price is equal to average total cost or marginal cost, right? So price is equal to marginal cost in perfect competition. Same. Here, if no firms earn economic profit, then what will happen? Everyone will be producing till the point where ATC is minimum. ATC is minimum means they all will be, the firm will be, all the industry together will be producing at the point where ATC is minimum. So there will be minimum efficient scale. They'll be producing till that point. Maximum production will happen when there is perfect competition. However, in monopolistic competition, do you think firms spend on marketing compared to perfect competition? In perfect competition, will you spend on marketing? No point. In monopolistic, yes, firms do spend on marketing, right? Because they want to highlight the differentiation in their product. Now, even though there are a large number of independent sellers here, right? They're selling closely substituted product, but they are highlighting the feature that our product is slightly differentiated, right? So they are not only competing on the basis of price, but also on quality, right? And that's why they have big marketing budgets. Their demand curves are highly elastic, but they are also downward sloping. Means they are not as exact as perfect competition. They are relatively downward sloping. So they, of course, in this case, if the prices are increased, the demand will fall. Now, as I said, what is the most important differentiation between both? We already know one differentiation, that perfect competition produces identical product, monopolistic produces slightly differentiated product. But in terms of graph, here what you need to understand, that perfect competition, the price is equal to marginal cost. Here the price is slightly higher, which I will show you why. It is basically a markup, that extra due to the product differentiation. So you need to cover that advertising cost, right? So the price is slightly higher than perfect competition. And what about the quantity I've written here? It is at the point where ATC is lowest, but here the ATC is not lowest, which is called excess capacity. Now, to make you understand these two critical points, I have placed that in the diagram here. See, this is the case of perfect competition, and this is the case of monopolistic. If you notice, Where is in perfect competition, the ATC is minimum. So the price is at equilibrium and quantity is also equilibrium, right? But if you notice in monopolistic competition, the ATC lowest is here. Sorry. The ATC lowest is here and the price is not at that point or quantity is not at that point. Ideally, the price should be slightly below, right? And the quantity should be more. Am I correct? Are you noticing that? But what do we notice that here the price is slightly higher and the quantity is lower. So we are not producing at the point where ATC is lowest. Therefore, what we could have produced is Q1, but we are producing only till Q. This is called excess capacity. Means we have an additional capacity, but we are not producing. Also, the price is slightly higher. That is due to markup. Why markup? Because we need more for advertising. This is the biggest difference between perfect competition and monopolistic competition. Everyone with me on this point? Check, 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 check. Understood this difference? Clear? Yes. Okay. Now we move on to the third one, which is my favorite, that is oligopoly. For sure, you're going to get one question on oligopoly. It is their favorite also. But within oligopoly, actually, there are multiple fragmentations. They depend on the number of firms. So there are 4 models of oligopoly. The most famous is kinged model. We'll first discuss king. King. For king, before I explain all this thing, see, look at this diagram of king. Here, there is a price and quantity. And imagine this is the case with airlines company. Airlines company actually face this. What do airlines company face? They are in a very tight competition. Now, suppose currently the market price is at this point. Now, if a particular airline decides to increase the price, what will happen? The competitors will not follow. Competitors will keep the price as it is. So, if the price is increased beyond a point, at this point, beyond this point, what will happen? I will increase the price, but the competitors will not follow. So due to this, what happens when the price increases? When the price increases, guys, the sales will drop, but it will drop at a drastically higher rate because others are not following. Therefore, it will be more elastic on the upside. When the price increases, what will happen? Sales will go down and it will be highly elastic, means the drop in the sales will be relatively much more or a bigger drop in sales. Compared to what? Compared to the point when the price is decreased. Now, see, as soon as the main airline decreases the price, what will others do? Do you think they will follow or not follow? Well, they will also follow and reduce the price. So when you decrease the price, you expect sales to increase, right? When you decrease the price, you expect your sales to increase, but the increase will not be enough. It will be less elastic. Why it is not enough? Because others have also decreased the price. So what I was expecting when I decrease the price, the sales will increase, but that increase is not enough because others have also followed me. This is the reason that the elasticity above and beyond this particular point, which is called kink, is very much different. Understood? Right? So that's why you don't see the demand curve in a linear format. It gets bended. That is what is called as kink. Got it? Now see the same thing I've written here. Increase in the firm's price will not be followed by the competitor, but decrease in the price will be followed. So even if the firm faces a downward sloping demand curve, what happens? That it is more elastic when the price is above the king, means there will be a huge loss. But when the price is below the king, what will happen? It becomes relatively less elastic. So the king price is the price where a firm produces relevant output, QK, which I've mentioned here. A firm believes that if it raises the price above, competitors will remain at the same point and it will lose the market share because of the high price. So price above point of king is relatively elastic and below is relatively less elastic. Everyone understood? That point is this point king. Clear? Right? Very common with the airlines industry. Now, one of the shortcomings of the model is that the model does not define exactly where this point is. So it doesn't tell you where the kink is located. So that is outside the scope of the model. That is one of the shortcomings. So it doesn't tell you where this PK is. Okay, it just tells you the reality of what is happening. Clear? Right? This is kinked. We are under oligopoly, kinked demand curve model or kink demand model, right? The most famous of all the oligopolies. Now, the second is cornet duopoly. Duopoly basically means there are only two players in duopoly, and they both make simultaneous decisions. Simultaneous means they try to imitate each other. Why? Because they probably know that whatever is my revenue, the balance is the other company's revenue, because there are only two firms. This is mostly common with the telecom sector, where there are two dominant firms mostly. For example, in UAE, you have Etisalat and Du. Correct? So in the cornet assumption, each firm determines its profit maximizing output by assuming that the other firm's output will not change. So I will decide how much is my output, and I will also know, based on the total market, what is the output of the other firm, right? Now, here some assumptions that we have only two firms, correct? Both firms have same and constant marginal cost, and each knows the quantity supplied by the other, correct? Now, because of this, I know that the quantity supplied by other, the firm can subtract this quantity from the market demand and how much it can suffice, right? So how much demand it can handle, the balance is what the competitors will be probably handling, right? A long run equilibrium is reached when both firms select the same quantity and there is no scope to earn economic profit by changing the quantity. So when is the long run equilibrium? It is achieved when both firms selects the same quantity, right? So in this case, the economic profits are slightly difficult, right? There's no economic profit. Now see, in the first case is perfect competition and monopolistic, there was no scope of economic profit. Why? In the long run. In the short run, there can be, but in the long run, not possible, because others will follow, because there are no barriers. In oligopoly, there are barriers, right? So what happens? The resultant price is less than profit maximizing of monopolies, but greater than that of the perfect competition. Due to this, there is a possibility of economic profit under oligopoly. Under oligopoly, there is a possibility of economic profit, correct? But remember here, if there is economic profit for a prolonged period, and if others find it difficult to enter, they find it easier to enter, and if new firms enter into the market, then this profit will disappear. So the market equilibrium price falls towards the marginal cost, limiting the firms from further profit. So again, here duopoly, there are possibility of economic profit, but ensuring that more number of players don't increase, right? So comparatively, duopoly market is very easy. There are only two players. Now, what you need to remember from the exam point of view, one thing, that they do the decision, they make the decision simultaneously. They look at each other and then make the decision of production. Third comes the Nash equilibrium. Nash equilibrium considers interdependency amongst the firm. This is where no collusion is expected. What is collusion? By the way, collusion is cartel. Cartel is a union of the firms, right? Now here, each firm tries to do the best considering the action of their rivals. So here, there is one very important thing. There is high interdependency amongst each other, right? Now to explain this, the Nash equilibrium, there is a situation which they have mentioned is called the game theory or the prisoner's dilemma. Now, before I discuss the prisoner's dilemma, from the finance point of view, from the economics point of view, remember, honoring in Nash equilibrium implies charging a higher price. And cheating means charging a lower price so that you get all the demand. All the demand comes on your side. This here, the most common example we are going to see is of the OPEC. In OPEC, there is a cartel. So if the entire cartel is united, then they will all charge a higher price by cutting down the production, right? But if some of the cartel members start cheating, which has been evident in the past, then they will reduce the price and sell it in the market to get the entire quantity, right? So what is Nash equilibrium? Nash explained in the prisoner's dilemma that suppose there are two prisoners and both have committed a crime, and now both are put up in a different box to confess, right? And they both are given an option that if they both remain silent, they both walk out with 6 months in the prison. But if they both confess, both will get 2 years. Now, of course, the best situation is that both should remain silent, right? But they are also being offered that if one of the person remains silent and if the other confesses, then the one who confesses will walk out free, but the other one gets a 10-year term in jail. Now, even if you would want to stay silent, you're not sure of the other person in the other room where he's being interrogated will remain silent or confess. Because if that person confesses, then you'll be put behind bars for 10 years. So in that fear that the other person can go against me and I'll be in the prison for 10 years, what happens, instead of they choosing the best alternative of both to remain silent, they have a fear that if I don't cheat, the other will cheat. So what happens? Eventually, they both end up confessing and not getting the best alternate. So confessing in Nash equilibrium is what the Nash equilibrium says. So Nash says, Professor John Nash, who got Nobel Prize, by the way, Professor John Nash mentioned that Nash equilibrium is where they both confess rather than remaining silent. Now, you look it from the company's point of view. Ideally, they all should have kept the high price, but they are in the fear. What if the other country will cheat? So in the OPEC, what happens? In the OPEC, they actually end up cheating. Why? With the fear that the other company will cheat, right? So collusion agreement is where there is an agreement to restrict output, which is common in OPEC, so that they get a better pricing. So in OPEC, now you have OPEC plus also. So it's a cartel such, which is called a collusion agreement, but the evidence is that the members regularly cheat on their agreement and they all end up, producing more and selling it at a lower price, correct? Now, under what case the agreement or the collusion agreement or the cartel will not basically break the law or will be successful? That is only possible basically in what case the cheating won't happen. It is only possible when there are very few firms and they are all selling the same product and same cost structures. The cost of production is relatively same. Purchases are relatively small and frequent from the buyers. Retaliation, like punishment for cheating, is more severe, correct? And there is no competition from outside. However, that's not the case right now. OPEC has a big competition from US itself, right? I've got a question. Collusive is for oligopoly. See, the term is this collusive agreement means a cartel. This is under oligopoly, under Nash equilibrium we are. Okay. So collusive agreement or cartel is under the oligopoly. Under that also we are under Nash equilibrium. Correct? Right? This is where the cartel is. So overall, what happens due to this? So as soon as you hear about the prisoner's dilemma or Nash equilibrium, that is nothing but collusive agreement or cartel. Most of the times, what is the outcome of this particular model? The outcome says that all cartels are not successful because most of the cartels are not successful because they end up going on the second best alternative. That is, they end up cheating rather than confessing, right? So from the economics point of view, they all should have lower production and higher price, but they end up cheating and then they all probably produce more at lower prices. This is the reason why oil prices can never shoot up above 100, because then now the cartel outside the cartel also there are big suppliers from Europe and US, and that's why the global prices of oil are relatively less. Understood? Clear? This is collusive agreement. Now, the fourth model under oligopoly is dominant firm, also called the Stackelberg model. What is dominant firm? Imagine here there is one lead company, let's say a lead bank in the country, the biggest bank in the country. Now, even if the interest rates are increasing, unless the lead bank increases the interest rate, others will not follow. So there is one leader and others will follow once the leader increases or decreases the prices. Correct? So under Cornet model, what happens? Remember, this is related to Cornet. In Cornet, there were only two firms, duopoly. There, the decision was done simultaneously. Means they did the decision together. Here in the Stackelberg model, which is also called the dominant firm model, the decision is done in sequence. Means the leader first takes the decision, has the first mover advantage, and then the others follow. They don't want to take a decision unless the leader takes the decision. So the optimal price and output are again at the same point where MC equals to MR, but the price followers follow the leader's price. So it happens in sequence, not simultaneously as duopoly. So within oligopoly, we have four models. Correct? What are the four models? Kinked demand curve, duopoly, dominant firm, and Nash equilibrium. Correct? Finally, the last model that we are going to do is monopoly. Monopoly is a single firm, single supplier. Correct? In monopoly, what is the pricing strategy? It faces a downward sloping demand curve. Now, many of the students ask me, shouldn't monopoly be selling at a highest price? No, monopolies don't want price maximization. They want profit maximization. And for profit maximization, you are willing to sell even at lower price so that you get highest demand. Understood? Now, assuming there is a single seller, monopoly firm must lower its price in order to sell more. Now, even if you are the monopoly and even if the price is highest, if you keep the highest price, what will happen? Those who are not able to afford will not buy simply, right? So monopolies are price searchers. They keep on searching the price at which the profit will be maximum. So their objective is to maximize profit. See, I've mentioned here, they don't need to charge the highest possible price because they want to get highest profits. And therefore, they apply two major pricing strategies. What are these two pricing strategies? Again, these two strategies are to maximize the profit, which happens at MC equals to MR. You see, this is repeating again and again, correct? Now here, even though there are high barriers to entry, the others will not enter into the market. So monopolist profits do not attract new entrants, which would be the case in perfect competition or monopolistic competition. If there are high profits, others will enter and the profit will disappear. In monopoly, that is not the case. In monopoly, in fact, long-term profits are highly possible. However, to maximize the profits, monopolies do not charge everyone a single price. They do something very interesting called as price discrimination. What is price discrimination? Opposite to single price. In single price, the monopoly probably is charging the same price to all the consumers. For example, fuel. We are all getting fuel at the same price. But under price discrimination, the monopoly will charge everyone different price based on the amount that they are willing to pay. So monopoly customers cannot resell. Suppose, and yeah, very important, price discrimination only works when you cannot resell it to someone else. So basically the monopoly is selling to the end user, right? If that is the case, then what happens? Then monopoly will try to sell each consumer at different price that they are willing to pay. This is very common in a movie ticket or an airline ticket. Have you noticed in the airline ticket selling, they use algorithm. So they are willing to sell the tickets at the price people are willing to pay. And many times when they have bulk tickets, they sell it at different price. Isn't it? They make it at affordable prices. This is the reason why if you see the number of people in an airplane, if you ask all of them, what is the price that they paid for the ticket, you will actually realize all of them paid different price, right? So they do perfect price discrimination. That's why you see many of the flights are completely full. So they are operating at full capacity. Isn't it? Why? Because of this amazing algorithmic tool where each user pays a different price. Understood? However, most of the monopolies globally are dominated by government companies, right? If you have a monopoly, which is a non-government or a private entity, or even if there is a chance of some of the firms becoming dominant, the anti-competition law takes into place in many of the countries where they do not allow some companies to monopolize. Yes, no one would want a private company to, no government generally wants private company to dominate the market unless and until it is desperate. Government companies can dominate the market. Therefore, many times they do not allow the firms to get concentrated. Hence, they do look out at a ratio called concentration ratio. This tells us the marketing power or the market power or the concentration of the market in the particular economy. So there are two ratios, N-firm concentration and Huffindel-Hirschman. First of all, N-firm concentration means it's the sum of the percentage of market share of let's say when I say N means it can be top 3, top 4, or top 5. So N firm concentration ratio is the sum of the percentage market share of, let's say, the top 4 firms. Hoffindel-Hirschman, on the other hand, is the sum of squares of the market share of the top 4 or top 5 firms. What is the difference? N firm is simply adding the market size or market share percentage. Hoffindel-Hirschman is a square. Now, what makes this squaring? Why do we do the square? Well, if you don't do the square, the N firm concentration ratio has one unique problem compared to HH index, is that it is insensitive to merger. Means if two top companies merge, then that effect of merger, which makes the market more concentrated, is not visible in N firm concentration ratio, but that is quite visible in Hoffindel-Hirschman index. So out of the two, Hoffindel-Hirschman is said to be relatively better. But they both lack one thing, that they do not take into consideration the market power or elasticity of demand, or they do not capture the elasticity. They both ignore the elasticity, and then they only look for absolute market share, right? In exam, if they ask you calculate N firm concentration ratio for top 4 firms, so whatever are the top 4, just add their market sizes. If they say Hoffindel-Hirschman index, take the square of their market share and then add it. Understood this? Correct? That is 2 questions related to it. Everyone, right? So it's a vast topic, right? But try to remain focused here. 4 market structure, perfect competition. Under imperfect, you have monopolistic. Then you have oligopoly. Within oligopoly, you have 4 models. And then you have, after that, you have monopoly, right? Correct? Which of the following is least likely a characteristics of perfect competition? The most common. Everyone. The product within a given market are homogeneous. Yes, no problem. Same. The demand curve of the individual firm is a vertical line. No, it's a horizontal line. In fact, none of them have vertical line. Either it's a downward sloping or a horizontal. So B is the wrong one. Correct, everyone? Very good. Based on the concept of diminishing returns, as the quantity of output increases, the short-run marginal cost of production will eventually, this is something that I have seen many students asking me doubt about this particular question. Now try to read it carefully. Okay. See, the concept of diminishing returns means your returns are decreasing as the output is increasing. When will this happen? When the costs are increasing, right? See, your output is increasing, but your costs are also increasing. Am I correct? I'll repeat, your output is increasing. So ideally, if the costs are reducing, then your profit should increase, right? But they are saying your returns are diminishing even if you are producing more, and that is because your marginal cost is rising, increasing, correct? So now the choice is between B and C, rise at decreasing rate or at increasing rate. Well, the answer is everyone in the class, the rise at increasing rate. Why? At decreasing rate happens, you can write it at decreasing rate, it happens only in long run. In the short run, this word short run, in the short run, it is increasing at a massive rate. Therefore, even if you're producing more, even if your output is increasing, your marginal cost is increasing at a very fast rate and your returns are diminishing. So yes, they are rising at decreasing rate in the long run, in the short run at increasing rate. This is by far one of the most complicated questions, and I would want you all to understand this and write down this. Okay. Next, which of the following is least likely a characteristics of oligopoly? Very easy, everyone. Products can either be similar or differentiated. Yes, no problem. There are few sellers. Yes. Relatively small economies of scale. Economies of scale is high. The first 2 are not the answer. So definitely it's the third one, right? Which of the following most accurately describes economies of scale? Guys, economies of scale are dependent on short-run average cost, increase at decreasing rate, occur when long-run unit cost fall at output increases. Very easy. Everyone see, correct? Economies of scale happens when cost per unit or ATC goes down. Clear? For profitable firms in an industry characterized by monopolistic competition over a long period, positive economic profits will tend to remain constant, decrease, or increase. First of all, will under monopolistic, can you make economic profits forever? No. Under perfect competition and under monopolistic, you cannot make economic profits forever. So will they remain constant? No. They will decrease even if the accounting profit remains positive. Why so? Because there are lack of barriers to entry. So as soon as there are profits, new firms will enter and capture the economic profit. Understood? So economic profit, even if they are, it will decrease. Now, when I say economic profit is zero, does not mean my accounting profit is zero. Accounting profit can be positive, but you're not recovering your opportunity cost. You're recovering your accounting cost, but not opportunity cost. So companies can be positive accounting profit. Their financial statements might be positive, but they're not covering economic profit. Understood? Here in economics, we are only focused on economic profit, not the accounting profit. Clear? Understood? Yes. So very lengthy topic is what we covered. Now, let us focus on the next topic, that is business cycle. Business cycle, this is where we come to the macro side. Here, we are going to understand the fluctuations that happen in the economic activity, right? Now, when I say what is the duration of a business cycle of an economy, well, it can range from some year to some, multiple years of 10 to 12 years also. Sometimes the business cycle can go for 10 to 12 years. In some economies, it can be, at times. And in fact, in the same economy, it can be at different phases, the time horizon is not fixed. It can range. For example, many people are saying that the 2007 recession is not yet over. We are still in a prolonged recession. Understood? Some say, no, we are in a rally after the pandemic. So again, it differs. But what are the major determinants of the business cycle? There are indicators. When we look at those indicators, we get to know that which phase of economic cycle we are or business cycle we are. There are 4 business cycle points that we discuss. Expansion, when the economy is growing and it reaches the peak. After that, it starts contracting and it reaches the bottom, which is called trough. The bottom, the lowest point is called trough. Contraction is where you see recession, economy is falling. Now, there are 4 factors on which everything is explained here. Economic activity. When I say economic activity means you can say aggregate demand or you can say GDP. So what is happening to the overall GDP? GDP is gross domestic product, the amount of goods and services produced by the economy in a single year. So what is happening to the economic activity? Whenever I say that means you can assume like a GDP or aggregate demand. So when the economy is expanding, of course, the GDP growth rate is accelerating at the peak. At the peak, the GDP, the growth rate has started to slow down. But when there is a recession, that means there is a decline in the output. Understood? Output is falling down at contraction. And at the bottom, when do I say we've reached the bottom? We've reached the bottom when the growth rate of economy turns from negative to positive. So when it turns from negative to positive, that means we can say that we've reached the bottom. Now the economy will recover from here back to expansion. So when the economy is at the bottom, that is where I would say the economy turns from negative. It's already falling in contraction. It is becoming negative till trough, where it recovers from negative to positive. That's where I will say I have reached the bottom. Understood? Now, when I say level of employment, here we are going to talk about unemployment. Unemployment, see, when the economy is expanding, unemployment level falls, isn't it? Because there are more jobs in the market. And when the economy reaches the peak, at that point, what happens? The business will slow down on hiring. Business will slow down their hiring. They will not hire more. However, still the economy is growing at a slow rate. Economy is growing, but at a slow rate. So the unemployment rate still keeps on falling. And why is that so? Because unemployment is a lagging indicator. It's a lagging indicator. So you will see its effect after the business cycle, not before. We will see the different types of indicators. But when the economy is in contraction, mostly companies do not immediately fire their employees. What they do, they freeze new hiring. They freeze new hiring, and they probably might be hiring only temporary workers. Or this is the point where I say unemployment rate still is continuing to fall. Why? Because it's a lagging indicator. However, when the economy turns to the worst point, that is straw, this is where you will see probably a prolonged recession. So here is what layoffs will happen. So layoffs don't happen immediately because it's difficult to hire and fire people, right? Unemployment remains high at this level over time, and temporary employees meet the rising product
No
demand.
need, take it.
Sorry? Yes? Hello? Anyone? Yeah. Anyone had a question? Check, check. Yeah. So here, what happens at the bottom is where you are laying off. And even if you require employees, many of the employees are working at temporary point. So unemployment is a lagging indicator, right? It will fall when the economy is growing, but when the economy shows the sign of recession, until it reaches the bottom, it is at the layoff point is at the bottom. However, it's a lagging indicator, so you will see its repercussion late. So even if the economy is contracting, unemployment doesn't immediately increase. It is still falling from the past. Consumer spending is actually one of the biggest component of the economy, right? Spendings will increase in tandem with the business cycle. So if the business cycle is expanding, the spendings will increase not only for individuals but even for companies. They order heavy equipments and engage in construction. Do you notice recently most of the global airlines are giving bulk orders of Airbus and Boeing? Boeing is having bad days, so I'll focus on Airbus. Huge orders, all the airline companies. I see when airline companies are doing that, either it is going to be disaster for airline companies or it's going to be recovery of the economy. So during expansion phase, business is giving orders for heavy equipment so that they can utilize it for production. Capex is still expanding in the later half of the peak. When the economy is at peak, Capex is still expanding. However, the growth rate has started to slow down because the economy has reached the peak. And when the economy is in the mode of contraction, this is where cutback happens. Cutback doesn't mean that you start selling the equipments. Cutback means the new orders are falling, or the new orders for new any orders for new heavy equipments followed with a lag in other forms of capex spending. So basically the new orders are delayed. People are not going for more orders because they fear the economy will go into a deep long recession. However, when the economy is at the bottom, there is an upturn often most pronounced in housing. The first growth comes up in the housing sector, consumer durables, and orders for light producer equipment. Consumer durables, furniture, and all those start picking up. When do economists say that the economy is now going to recover? When they see demand in housing, consumer spending on durable goods, or equipment ordering, not heavy equipment, but ordering of basic equipment, industrial tools. When their demand is rising, we say that economy is now reached at the bottom. Now it will recover from this point. The last is inflation. Inflation is also a lagging indicator. So inflation has a very interesting story. When the economy is expanding, inflation is also modestly expanding, accelerating when it reaches peak. But when the economy is in recession, it is not falling badly. It is decelerating, but with a lag. As I said, it's a lagging indicator. So you will see the repercussion of inflation, not exactly with the business cycle. So the business cycle is contracting, but inflation is still relatively high. It's now starting to ease out, but it's still relatively high. And later, when the economy reaches at the bottom, inflation remains moderate and then might continue to fall at the deepest point. Understood? Correct? Overall, there are various indicators. So before I discuss the fluctuation, let me discuss these indicators first. There are three major types of indicators: leading, coincident, and lagging. All those indicators that I discussed with you, right? Inflation, everyone. Inflation, unemployment, correct? In fact, inflation, unemployment, the industrial loans, commercial and industrial loans data, or loans ratio, prime lending rate, that is an interest rate. All of these are lagging indicators. One of the lagging indicators that we are going to discuss is the inventory to sales ratio. What are lagging indicators? They don't tend to change direction until after the expansion or contraction. So basically, they give us the change. They give us the change. They are known to change direction after the business cycle. What are the ones which are known to change before the business cycle? They are called the leading indicators. So the stock market index tells you before time. The bond yields tell you before time. Building permits, the orders for building permits, right? The request for building permits to build more, you have to go to the authority and ask for permission. That tells you that the economy is going to expand, correct? Leading credit index, how much people are taking borrowings, 10-year treasury spread, consumer expectation. See, stock market and bond yield, those are market oriented. They are leading indicators. Coincident indicators, they roughly tell us about the change at the same time as the economic cycle. Here, some of the indicators include real personal income adjusted for inflation, index of industrial production, manufacturing and trade sales. It is more real time. It is published immediately, generally weekly and so on. So that tells you what is happening in the economy right now. Understood? Now, some of the factors which causes cyclical swings or fluctuation in the economy, these are the factors of this. Most important factor is the credit cycle. What is credit cycle? It is fluctuation in interest rate generally dictated by the monetary policy that will tell us the availability of credit. Now, expansions are stronger and contractions are deeper and are longer in duration than business cycle. So see, what is credit cycle going to do? Well, credit cycle inflates the economy. So if the economy is at expansion, a credit cycle boom will make it stronger. If the economy is in recession or contraction, it will make it much deeper. Not only deeper and stronger, but for a prolonged period. So credit cycle amplifies everything, amplifies the business cycle. So whatever the business cycle is into, credit cycle will push for it. In fact, credit cycle is the reason behind the 2007-8 asset price bubble, especially about the housing prices. So credit cycle is related to asset price bubble. Please keep that in mind. It creates asset price bubble and it is said to be deeper and stronger and longer. Understood? It actually, ignites the business cycle. The second important is inventory to sales ratio, the lagging indicator, right? See, inventory over sales, inventory over sales. Now, when the economy is moving from expansion to peak, it is going from expansion to the extreme high level. At that time, one very interesting thing happens that you keep your inventories at the highest level, but the sales have now started falling down. And even if the sales at the same level, what is happening? You have started accumulating the inventory. That is a sign that you are unable to sell the inventory. So the ratio increases above the normal, and that's a sign of economic slowdown. So friends, when the inventory to sales ratio is above normal, that means we are in a slowdown. Understood? But when when contraction is approaching trough, means you are reaching at the bottom. So there's nothing worse than this. So when the contraction is reaching at the bottom, the ratio decreases below normal. Why? Because your inventory is limited and the sales has started increasing. So here the inventory started accumulating even if the sales are at the same level. Here what happens? The sales are increasing at the same inventory and therefore you will see the ratio falling below. So whenever the inventory to sales ratio is above normal, that means there's going to be a recession. Whenever the sales ratio is below normal, that means the economy started picking up. Understood? Inventory to sales ratio is below. Labor force and capital. These are two factors of production, everyone. Labor force. Do you think companies hire and fire immediately? No, it's the most difficult job. So adding or subtracting the labor or removing the labor happens in lockstep. It doesn't happen immediately. You take the extreme step only if you think the economy is going to persist in the same phase for a longer period. Means if the economy you think is going to expand for a longer period, only then you hire more people. Otherwise, you try to make them do the overtiming or you hire temporary workers. Similarly, if the economy is going to be in a prolonged recession, only then you take the extreme step of firing people. Understood? Now, with capital, spending, capital spending, when the cycle is temporary, production levels are adjusted. You don't immediately cut down on production, you try to adjust it. How? For example, when the economy is in expansion, we increase the production capacity by how? By investing more in PPE. However, during contractions, this means you are expecting contraction. In that case, the spending is less on maintenance and delaying of replacement happens. So you're trying to adjust it. Okay. So when the economy is expanding, only then you invest in PPE, property, plant, equipment. But if it's in contraction, you don't sell property, plant, equipment. You don't cut down on your capacity extremely. What you do, you try to spend less on maintenance, delay your replacement of equipments. Understood, everyone? Now we'll see consumer spending, the most important of all. Consumer spending is said to be, by the way, to know consumer spending, it's a leading indicator when you see the consumer spending index. But consumer spending is one of the largest component of GDP. And it does depend on the consumer's current and future income level. So if the consumers think that their future income will increase, they will start spending more, or they will start reducing their spending if they think the future economy will go into recession. Now here, different types of goods, for example, durable goods. When I say durable goods means furnitures or cars, luxury cars, they are very sensitive to the business cycle. Similarly, some services are very sensitive, like exclusive holidays, or restaurants, or your travel, luxury travel. These are more sensitive. But the essential ones are less sensitive. Essentials include, when I say essentials in the sense of goods, they are called non-durables. Non-durable are your perishable goods like food, clothing. They are basic, perishable goods. They have a very low shelf life of less than 3 years. They are relatively stable. They are less sensitive to the business cycles. Similarly, essential services like power usage or electricity, those are essential and they are less sensitive to the business cycle, right? So consumer spending, what is more sensitive? The durable goods or non-discretionary services are more sensitive. Housing is very sensitive to cyclical swings. Yes, if the economy is expanding, right, the interest rates, let's say if the monetary policy decides to keep the interest rates low, and so the mortgage rates and mortgage rates will be low, not only for the buyers, but even for the suppliers. For them, the cost of production will be low. Now, in that case, the overall housing cost will be low. There will be more speculation, and also demographic contributions, demographic conditions make a big impact here. So all of these are the factors that will lead to increase or decrease in housing. So housing majorly depends on the business cycle and the market availability of credit and interest rates. Correct? Demography, yes, if there's more expansion happening in a particular zone or a city, there will be, because of that, what will happen? There will be more buying of houses there. Also, if you have a more younger population, more people are willing to rent, so the rental yield will also increase, right? That will increase the chances of speculation. People will buy more homes to earn higher incomes. External trade is very crucial. Domestic GDP. What will cause your domestic GDP to grow? Your income levels of the consumers, or everyone is rising. So if the economy is expanding domestically, people will buy more of imported goods, luxury goods, right? So when the domestic GDP is increasing, imports will increasing. But what if the growth rate in GDP of your foreign partner? So if your foreign partner's GDP is increasing, they'll demand more of your goods, so your exports will increase. So guys, if you want to increase your exports, your foreign partners GDP should increase, isn't it? And if you want to increase your imports, so what will happen when our economy grows? Imports will grow. Understood? Now, currency also plays an important role. So if your domestic currency depreciates, yes, if the local currency depreciates, our goods become cheaper in the global market, so our exports will increase. But if our currency appreciates, our currency appreciates means the foreign currency depreciates. When I say my currency appreciates means the foreign currency depreciates. When that happens, what becomes? The foreign goods become costlier for us. So Did I say that? Sorry, my mistake. So see, if the domestic currency depreciates, our goods become cheaper in the global market, right? So our exports will increase. But yes, when the foreign currency depreciates, or domestic currency appreciates, so foreign goods become cheaper, so our imports will increase. Yes. So overall, domestic currency depreciating will lead to increase in exports. Foreign currency depreciating will lead to increase in imports. Understood, everyone? Clear? So what causes more exports? I'll repeat, domestic currency depreciating and growth in foreign partners' GDP. Both will cause my exports to rise. But what will cause my imports to rise? Foreign currency depreciating or domestic GDP increasing. Understood this part? Clear? Let us do questions related to it, everyone. Very interesting. Okay. So, everyone in the class? Yes, visible? Let's do these questions. Now, here, which of the following statements about credit cycle is most accurate? Which of the following is most accurate? Here, a typical business cycle includes two or more credit cycle. Credit cycle tend to dampen the business cycle. Credit cycle are a potential cause of asset price bubble. Everyone in the class? Credit cycles are the potential cause of asset price bubble. That is the answer. C, everyone, not B. C is the answer. As I said, credit cycle, they do what? They amplify the business cycle. So credit cycles are known to amplify the business cycle, correct? A peak in the business cycle is most likely associated with highest level of economic output, everyone. During the cycle, payroll, employment turning from positive to negative, decreasing inflation pressure. Yes, everyone. Yes, so a peak in business cycle is most likely associated with, yes, everyone answer. Let us see what are the answers. What are the answer? Okay, see what happens during the peak. Yes, the answer is A. Why A? The highest level of economic output during the cycle. Now, what is the problem with the BNC? Payroll, employment turning from positive to negative. When does this happen? This positive, negative, it happens at the later stage, right? Decreasing inflation pressure. No, inflation is increasing at peak, a peak at the peak. What? In fact, the inflation is accelerating. So decreasing, not the case, right? Third, an economy has been producing at its full employment level of output and the price level has been stable. Businesses then begin experiencing unintended decrease in their inventory levels. So what is happening? The inventory levels are falling. Now, why are the inventories level are falling? Because we are selling off the inventory, right? What does this most likely imply about the short-term outlook for economic growth and inflation? First of all, when the inventory levels are falling, that's a good thing or a bad thing? Inventory levels are falling. See, in the inventory to sales ratio, if the inventories are, you are not able to sell it, then the inventories will accumulate. So inventories are falling. That's a good sign. That means the economy is expanding, correct? The economy is growing. So out of this, the economic growth, when it comes to economic growth, the answer should be A or B. Now, what about inflation? What will cause the inflation? See, here they are saying economy is already at the full employment and, and the price level has been stable. But now they are saying the business then begins experiencing unintended decrease in inventory. Now, whenever there is decreasing in inventory and the economy is expanding, what will happen? The production will increase. Production will increase because the inventory levels are going down. And as the production increases, price and quantity both will increase. This will cause even the inflation to increase. So the situation will be A, economic growth will increase. Yes, because there will be more production, but also inflation will increase. Understood? Clear? Very interesting. Next, the expansion phase of business cycle is most likely characterized by decreasing inflationary pressures, The rate of economic growth changing from negative to positive. See, the growth of economy becoming from negative to positive, that happens at the bottom, the trough, not at the expansion. At the expansion, what will happen? Inflation also goes with expansion, isn't it? So inflation also goes ahead with expansion. However, what happens at the expansion of business cycle is most likely characterized by decreasing inflationary pressures. See, when the expansion is there, look at the inflation. Inflation picks up modestly, right? Inflation accelerates, then decelerates with a lag and remains moderate. Now, they said at the expansion phase of business cycle, it is characterized. What is the characteristics at expansion? At expansion at this point. So remember in your mind that when you are in expansion, you are just recovering from the bottom. So the inflation pressures are not relatively as high. Okay. But it doesn't mean that they are decreasing. In fact, at expansion, inflation starts rising. The rate of economic growth changing from negative to positive, as we discussed, that is at the bottom, correct? Increasing employment, yes, employment will increase. So at expansion phase, the only correct option is C. Why is A wrong? Because inflation is low, but not decreasing. It is started to increase. Understood? Last, increase in firms inventory to sales ratio. See, whenever the inventory to sales ratio are increasing, that's a bad sign. Okay. Are most likely to occur just before the peak in the economic cycle. See, check here. Just before the peak. Where did we discuss inventory to sales ratio? See here. Inventory to sales. As the economy goes from expansion to peak, as the economy goes from expansion to peak. So just before reaching the peak, what is the peak point? The peak point is when you have accumulated a lot of inventory and you are unable to sell it. So yes, just before the peak, the inventory to sales ratio is above the normal. So firms inventory to sales ratio are most likely to be just before the peak, correct? During contraction, no. Just after the trough, no. Understood? So when the economy is moving from expansion to the peak, this is where we will have the highest inventory to sales ratio. So we have accumulated a lot of inventory. We have unsold inventory. Therefore, just before the peak, the inventory to sales ratio is highest. Okay. See, I'll tell you one thing. It looks easy. Economics looks easy while reading, but while doing the question, it is not that easy. So I suggest you to do as many questions practicing as follows, right? I mean, as possible. So let's say in this part one of session of, this economics, I'm also going to now cover fiscal multiplier, right? Or fiscal policy. However, since in the part one, you will only see 2 or 3 topics, what I would recommend you is that immediately what you should do, immediately you should go ahead and solve as many questions of each of the topics. Because I have noticed with other topics, it's fine, but with economics, people understand the concept, but when it comes to applying in question, this is by far one of the most difficult. So it's very difficult to score 70 plus in the initial phase. Okay. So I've seen based on students' marks, I have observed that scoring in economics is difficult and you don't realize it while you're practicing. Everyone understood? Clear? Right? So now let's move on to fiscal policy. Okay. Now, by the way, there are 2 parts of this. Was actually initially a part of monetary and fiscal policy. Both were together, but now they've separated both. So individually, the topic has become relatively less in size. Fiscal policy talks about the government. Fiscal policy is managed by the government. So it talks about the government's use of spending and taxation. Government spends money on the economy. We will see what are the spending tools, and taxes the economy to generate revenue. All of this comes under the macroeconomy, and the government does it for the macroeconomic goals, for achieving the macroeconomic goals. A very frequent question is, what is the objective of fiscal policy? Now, of course, the objective is to increase the aggregate demand, or basically the GDP. So influencing the economic activity or aggregate demand. Whenever this aggregate demand means the GDP. Okay. So influencing the GDP is the primary goal, but One unique thing which separates fiscal policy from monetary policy, by the way, first point that I discussed, economic activity increasing, that is also the goal of monetary policy. But fiscal policy has one unique thing, that is redistributing wealth and income among different segments of the population. Therefore, under the taxation law, most of us have progressive taxation. What do you mean by progressive taxation? Under progressive taxation, the rich pays more taxes. That's what common in most of the economies, right? So the objective is to allocate the resources among different sections of the economy. So redistributing the wealth or allocating among different sections of the economy. So, charging the rich more taxes and distributing it to the poor. It's more of a social equality. I call fiscal policy is more like Robin Hood. Understood? Now, there are economic theories based on the fiscal policy management and monetary policy. The most famous theory in the world is by Professor John Maynard Keynes, which is called the Keynesian theory. Today also, most of us rely on that theory. Now, contrary to that, there is a monetarists. I'll explain you both. Keynesian says, or Keynesian economists, category types of economists believe that fiscal policy is the solution. Means through fiscal policy, there can be an effect on aggregate demand, have strong effect on the economic growth when the economy is operating at less than full employment. What does it mean? That when the economy is struggling, not at its full capacity, then through fiscal policy, means through government intervention, what can happen? We can influence the economic growth by increasing the aggregate demand. Probably by how? By, let's say, by reducing the taxes. Understood? One of the ways. I'll explain you various other ways. So that is what Keynesian said. So in 1929, when the US economy was going through Great Depression, John Maynard Keynes suggested that the government will have to intervene and boost the demand. Otherwise, the economy will never revive. Understood? Monetarists, on the other end, do not agree with this. They say they believe that fiscal stimulus is only temporary. It's not a permanent solution. You cannot revive the economy just by reducing the taxes forever or by supplying more money. And it should be used to decrease inflationary pressures over time. So economists believes that fiscal policy can be used to increase the economic activity. Monetarists believe that it is only useful to manage inflationary pressure, nothing more. You cannot influence the economic growth. But why are they called monetarists? Well, they are called monetarists for one reason, that they believe that monetary policy should not be used at all. In fact, they think monetary policy is a waste, and monetary policy is the reason due to which we have so much of cycles in the economy because of oversupplying of money and pulling out of money by the central bank. So they don't believe that monetary policy is the solution and should not be used to influence the aggregate demand. In fact, they say it is counter-cyclical to the movements in economy. So it is bad for the economy. So monetarists are very pessimistic. They think fiscal policies only uses controlling inflation, and monetary policy is rather counter-cyclical. Economists, Keynesian economists, they believe, yes, it is fiscal policy which can boost the aggregate demand. Clear? Now, to do so, governments either intervene themselves, that is called discretionary fiscal policy, means they take the decisions of spending and taxes. They will decide when to increase or decrease the taxes or when to increase or decrease the spending, right? So these are intended measures by the government to stabilize the economy. That is called discretionary, at the discretion of government. However, many economies have automatic stabilizers. So the government need not intervene. It automatically adjusts. By how? First, these are built-in mechanisms. And by how does this happen? Well, if you need only two things in the economy. One is tax and unemployment benefit, which is the case in US also. So what happens due to having taxes and unemployment benefits or unemployment payments? If the economy is in recession, correct? The fiscal policy has to be expansionary, and it will automatically be expansionary. Why? Because the tax collection will be low and more unemployment benefit will be paid. And if the economy is in expansion, the fiscal policy needs to be contractionary to control inflation. It will automatically happen. How? Because the more profits, the more tax will be paid and lesser unemployment benefits. So because of this system of having taxes and unemployment insurance or benefit, the economy is automatically balanced. there need not be manual intervention by the government for expanding or contracting the economy. Those are called automatic stabilizers. Most of the economies have automatic stabilizers. Understood? Especially the Western economies. Now, do you think most of the economies in the world have a fiscal surplus or a fiscal deficit? By the way, when I say fiscal deficit, what is the meaning of fiscal deficit? Means my spending is more than my taxes, or I can say my revenues are less and my income, my revenues, basically my revenue or income is less than my cost. So here, if the spending is more than the taxes, then the budget is at deficit. Everyone understands this? So when the budget is at deficit, for example, let's say when your salary is less than your spending, what will we do? Well, we'll go for borrowing. So governments, when they face deficit, they increase the government borrowing or government debt. So when government has insufficient tax revenue to meet the expenditure, they need to borrow from the public. And when the outstanding stock of debt falls, budget surplus rises. But when the debt increases, when the debt basically increases, what will happen? Your more payment will go towards interest, and that will lead to more fall in the surplus or more deficit. So in fact, it's a spiral. What happens that if you are at deficit and if you borrow, you will be in a prolonged deficit because you'll be paying higher and higher interest. So having a higher debt will lead to fall in your budget surplus if there is any, or rise in the deficit if any. Understood? Now, is it a concern or not? We will see, but that all matters how much is my debt. So the total size of your debt means the government debt, is basically the cumulative borrowing, net borrowing. When I say cumulative net borrowing, plus net borrowing means any repayment excluded, plus any fiscal deficit in the current period. So let's say till now I have borrowed, let's say I'm a US economy and till now I've borrowed $2 trillion. And this year my budget is at deficit of $500 billion. So I will have to borrow $500 billion. So my cumulative quantity will be 2 trillion till date plus half a trillion. That will be 2.5 trillion will be my total size of outstanding debt. Now, based on this, we calculate the debt to GDP ratio of the economy. What is debt to GDP ratio? It's the aggregate debt of the economy compared to its GDP. That is called debt to GDP ratio. Do we want an economy's debt to GDP ratio to be higher or lower? Like companies, we want debt to GDP ratio or debt to revenue ratio for company. Your debt to GDP ratio for the economy, we want it to be lower. But if the economy is in a prolonged fiscal deficit, this debt to GDP ratio keeps on rising. Understood, everyone? Do you know most of the economies have debt to GDP ratio above 100%? Means their debt is more than, their aggregate debt is more than 100% of their GDP, right? But many students or many economists don't consider this as a problem. So very important from your exam point of view, having higher level of debt or basically due to high fiscal deficit. Why do you have more debt? Why do you have more debt? Because of high size of fiscal deficit. Now, there are arguments for being concerned about it, and there are arguments against being concerned. About what? About the size of fiscal debt, because the size of fiscal debt eventually will lead to more aggregate debt, and that will lead to more debt to GDP ratio. So there are two types of economist view, very much frequently asked in exam also, and I will discuss both. What is that view? The viewpoint is that something it is a concern and some says it is not a concern. For those who believe it's a concern, what is the reason? That, see, they say very logically that the economy is going to keep on borrowing more and more, right? That means government at some point of time will need revenue to pay. So that will lead to higher future taxes, right? And if the government is going to be prolonged having higher future taxes, prolonged going to borrow, depend on borrowing, and it will increase the taxes, the consumers will lose confidence in the government and they will not be willing to refinance the government debt because they think at some point of time this bubble will crash. Also, because the government is constantly borrowing. So the borrowing market is dominated by the government, and that creates a crowding out effect. Means very less amount is left for the private sector to borrow, and that will increase their cost of borrowing. So the major debt market is dominated by government. All the borrowing is squeezed by the government. So this is the ill effect, right? So apart from increasing of taxes and market losing confidence, there is lack of capital in the market for the private sector. But some say this is not a concern when, especially if the debt is primarily held by domestic citizens. So it's in local currency, so then it's not a problem. Yes, if it's in foreign currency, then you might have to pay foreign currency. That can be a problem. But domestic currency, not a problem. Also, if this debt, if this fiscal deficit is rather used for some productive use or building capacity or infrastructure, then it is not a problem because it will generate revenue to repay the debt in the future. For example, I've borrowed a lot of money to create roads and bridges and all. That's not a problem, right? In the long run, you will get gains to repay. Third, deficit may prompt needed tax reform, means it will make the economy more efficient in terms of taxes. And it would not matter if the private sector savings in anticipation of future tax liabilities just offset the government deficit. By the way, this is called Ricardian equivalence also. What does it mean? It means that the government is borrowing, right, at the cost that people will spend. But if people are not spending, they will keep on saving more because of they are worried about the future taxes. So because the savings will increase, the private sector savings will increase. So that will exactly match the government borrowing. So overall, government is borrowing more, but the private sector is saving more, acting as a cushion for the government deficit. So whatever the government has a deficit, there's more money in the economy by the private savings. Correct? So then they are saying it should not be a concern because there is a lot of savings in the market. And finally, deficit can increase the GDP and employment. So it's not a concern. In fact, let me tell you, most of the economies are at a fiscal deficit for a prolonged period. Understood? So there are arguments on both the sides. Now, when I say fiscal deficit is connected with two things, spending and taxes, that is revenue. So two tools, the revenue tools and the spending tools. Spending, where does the government spend? Giving unemployment benefits, redistributing the wealth. Those are all called transfer payment, unemployment insurance. All of these transfer payment, social security benefit in US, all of these are benefits given by the government, aids, donations, etc. Right? Are they included in GDP? Remember, transfer payments are not a part of GDP. Understood? Then there are two more places where the government spends majorly, that is current and capital spending. So everything that is purchase of goods and services, that comes under current spending. But investment in long-term infrastructure or creating assets, road, bridges, railways to boost the future productivity or generate infrastructure for the economy, that is capital spending, long-term spending. So this is where the government spends. Many students ask me, how does the government pay salaries of its employees and all? That comes under current spending, right? Revenue tools. Revenue tools. How does the government generate money? Taxes. Two form of taxes, direct taxes and indirect taxes. Direct taxes is either on income or wealth of individuals or corporates. You might be taxed on the insurance amount that you get. Wealth tax or estate tax. In US, you have wealth and estate tax. Means estate tax when you transfer the money to your children. There is an estate or inheritance tax. Wealth tax is on the asset that you own, right? Income tax is on your salary, and most of these taxes are progressive, means the more the amount, the more the income, the more taxes you pay. Correct? That is direct tax. Some countries like UAE do not have direct tax, but now corporates do pay tax. So direct tax has also been resumed. Indirect tax, which is taxes on consumption, that is on goods and services, right? In many countries, it is called sales tax, value added tax, excise tax, or goods and services tax, basically GST. It can be used to reduce consumption to ease down the inflation pressure, or sometimes it is called a sin tax on those goods which the government don't want you to consume. For example, on alcohol, tobacco, or gambling, that is heavily taxed. Of course, officially they say the intention is to reduce the consumption, but the reality is they know people who are consuming are not going to stop it, and that's what is the biggest revenue for the government. Okay. Now, What are the advantages of this fiscal tools? We are going to understand the advantage and disadvantage. First of all, the reason of fiscal policy is redistribution of wealth. So social policies such as discouraging tobacco can be implemented using fiscal tools by adding more taxes on the consumption. And which one do you think is the favorite of government, direct tax or indirect tax? Which one do you think government loves charging, direct or indirect tax? Indirect tax. Why? Because it is easier to collect. It is quick. Quick implementation of indirect tax means governments favor this. Why? Because it is paid by everyone. Direct tax is paid by those who qualify being rich, right? Or being in that income slab. But indirect tax is paid by everyone immediately. So that is the quickest implementation happens at indirect tax. So that is also government's favorite. These are the advantages of fiscal policy. What are the disadvantages? The disadvantage is that direct taxes and transfer payment, they take very much time to implement. So your desired, objective might not happen immediately. Also, capital spending. On the spending side, the capital spending is long-term in nature. So you will not see its desired effect into the economy immediately. So these are the disadvantages. And many of these disadvantages because of the fact that the implementation takes time, which we are going to understand later on, the difficulties in execution of fiscal policy called the lags, recognition lag, action lag, or implementation lag. So we will see the disadvantage. From here, I will go to the part of having a disadvantage. That is the difficulties. We will cover the fiscal multiplier in a moment. But first, understand what are the problems in implementation. In implementation, the problem with executing fiscal policy is the recognition lag. Recognition lag means, see, sometimes the economic indicator or the quantitative models used by economists, they take time to collect the information or survey. And because of this, because the data is collected late, you get to know the health of the economy very late. So to collect the information faster, you can improvise the tools, but because most of the economies collect this data at a massive scale in a form of a survey or a sample, so because of that statistical data getting late, most of the indicators, important indicators, you see, they are lagging indicators. So because of that, we get to know about the health of the economy relatively late. That is called a recognition lag. Then there is an action or execution lag. In many of the democratic countries, the government cannot simply take the decision immediately. It has to go through the different layers of constitution and parliamentary bills and all executives, and then it gets implemented. So it's a time lengthy process in democratic nations, right? So the policy changes are decided. It may take months to implement. It is many times debated in the legislation. Only when everyone agrees through voting, then it takes place. So the action takes time. And finally, once the action is implemented, the implementation might also take time to affect the economy, as we saw with capital spending. So recognition lag, action lag, and implementation lag will sometimes make the fiscal policy not only ineffective, but counterproductive. Means you will actually treat the patient so late that the patient has recovered and now the medicine will probably have a side effect, right? That is the effect of lag, right? Okay. So we covered till this point. Now we will understand what is the fiscal multiplier. Fiscal multiplier is a very, very interesting component, which I will discuss. And this has some, not exactly calculation, but through calculation, I'll try to explain you what is fiscal multiplier. Now, fiscal multiplier is a very interesting topic. Why do we call it multiplier? It is called multiplier because when the government decides on spending, what happens? The money goes into the economy, it's used by the consumer, and the consumer will pay taxes, and then it will be buying some goods and services. So when it buys and goods and services, it goes to someone else, and that person will start spending. In this way, the money, the spending that the government does keeps on rotating in the economy multiple times. So every dollar spent by the government, right, it actually translates into multiple times in the economy. So its effect into increasing the aggregate output or demand is much more higher. That is called multiplier. So fiscal multiplier determines the potential increase in aggregate demand or GDP from the increase in government spending. For simplicity, I'm going to put here some numbers. It was done by one of the students of John Maynard Keynes. So it is based on that concept. Now, for our simplicity here, we will assume that the government is willing to spend, let's say, $100 billion, 100 for simplicity. So this is what the government is intending to spend into the economy, right? Now, two terms that we need to know is marginal propensity to consume. What is marginal propensity to consume? So every dollar that the government is spending on you, let's say the government gives me $1 in whatever form. Out of that $1 income that I have, how much am I going to consume and how much am I going to save? So out of that $1, if I'm going to spend or consume 40% or let's say 80%, so my marginal propensity to consume is 0.8. So what is the savings? The remaining 20%. So out of every dollar, how much am I saving? 0.2. How much am I consuming? 0.8. Now, if I want to grow the economy, do you think people should consume more or save more? If you want to grow the economy, you want people to consume more. Am I correct? So the MPC should be higher. So if the MPC is higher, what will happen? The fiscal multiplier will increase. How? I will show you. So if the MPC increases, the fiscal multiplier increases. Everyone. But before understanding fiscal multiplier formula, what is disposable income? Disposable means whatever is my income minus taxes. The net income after taxes. Suppose I get $100, I pay 20% taxes. So that $80 is my disposable income, which I'm going to spend. Correct? Out of that, some amount I might spend, some amount I might save. So my MPC being 80 or 0.8, I'll spend 80% of my income. The balance I'll save. So additional spending is disposable income into MPC. So suppose if my gross income is 100 into 1 minus tax, let's say tax rate is 20% or let's say 25% for our simplicity here. 100 into 1 minus 0.25, I'm keeping the tax rate as 25%. Okay. So my disposable income will be $75. Out of that 75, if I say 80% is my marginal propensity to consume, so 75 into 0.8, $60 is what I will spend. The more the propensity to consume, the more I will spend, isn't it? Now, every dollar that I spend, that is marginal propensity to consume, minus the tax rate. So MPC into 1 minus tax rate. And based on this formula, I will get a fiscal multiplier. So I've given you the tax rate here and the MPC. So can we calculate fiscal multiplier based on this formula? Just for the reference here. So our fiscal multiplier, I'll also put it here. So imagine the marginal propensity to consume is 80. Tax rate is 25%. So my fiscal multiplier will be what? 1 over 1 minus marginal propensity to consume into 1 minus tax rate in the formula. So if you do this 0.8 into 0.75 minus 1 inverse, you will get a fiscal multiplier of 2.5 times. What does this mean? It means that every dollar spent by the government will have increase in the aggregate demand by 2.5 times. Everyone understood this? So imagine now how much, if they ask me, how much will be the increase in aggregate demand based on the spending by the government. Let's say the government decides to spend $100 in the economy. So the aggregate demand will increase by how much? By how much? It will increase by the fiscal multiplier into the spending. So if the multiplier is 2.5 times, and if the government is spending $100, the aggregate demand will increase by $250, means the economy will grow by $250. So government will spend $100 billion, the economy will grow by $250 billion. Understood this, everyone? So the multiplier effect is basically whatever the government spends, how much times the economy will grow. That is called fiscal multiplier. Clear? Right? But guys, for the government to spend $100, the government needs $100 of income also, right? So first part, let us understand this in phases. So first of all, what did we learn here? That as the fiscal multiplier increases, and that will only happen when MPC increases, or I can say when tax rate goes down. So when tax rate goes down, or when marginal propensity increases, what to consume increases, what will happen? That there will be an increase in the aggregate demand. Correct? But now to increase the aggregate demand, the government will have to spend $100. So to spend $100, what if the government decides to balance the budget? How can I balance the budget? Well, I can balance the budget by taxing the economy $100 billion more. So increasing taxes. So this way the budget is balanced, isn't it? Because now the government is collecting $100 billion of taxes and spending $100 billion in the economy. Well, the amount that you spend, $100 billion that you spend in the economy, will increase the aggregate demand. However, the more taxes now, what will happen? Increase in taxes by $100 billion is done to offset the spending, right? But what will happen due to increase in spending? Due to increase in spending, the disposable income that we calculated here will what? Reduce. And that will lead to decrease in aggregate demand, opposite. So there will be initial decrease in spending. How much will be the decrease in spending? And that will lead to decrease in aggregate demand. So whatever is the increase in taxes into the marginal propensity to consume. So if the government had not charged these taxes, I was supposed to consume. So now what happens here? Sorry, the government has decided to increase the taxes. So based on those taxes into the marginal propensity, how much of that tax I was going to consume, times the fiscal multiplier, that will be the reduction in aggregate demand due to increase in taxes. Yes. And how much is that? Let us calculate that. So the government has increased the taxes by $100 billion, correct? And of that, 80% was that people were going to spend. And all of this will have a multiplier effect of 2.5 times. Overall, you will notice this will lead to $200 billion of drop in the sales or drop in the aggregate demand. Now tell me here one interesting thing. Has the budget been balanced? Is the budget balanced? Yes, because the spending and taxes are both same at $100. Isn't it? Both are $100. So the budget is balanced. Because of spending, the aggregate demand increased by $250 billion. But because of taxes, the aggregate demand decreased by $200 billion. Overall, even if the budget is balanced, what is happening? The net aggregate demand is always increasing. This is not mathematics. This is economics. What is happening? The net effect is that even if you balance the budget, so combining what? Total increase in aggregate demand due to $100 spending by the government and decrease in demand due to $100 taxes, the budget is balanced. But the most important thing that you need to know from the exam is that the net effect on aggregate demand of both increase will both lead to increase in aggregate demand. So even if the budget is balanced, the budget multiplier is positive. What do you mean by this? So at balanced budget means the government, even if government spends $100 and taxes $100, even if the budget is balanced, the aggregate demand will always keep on rising. The net aggregate demand will be higher, positive, not zero, positive. Yes, this is a new thing. This is a very interesting thing. So conclusion, that tomorrow in the future, if the government is increasing taxes and simultaneously spending the entire amount in the economy, the net effect is that the budget is balanced, but the aggregate demand, the GDP, will grow. Understood? Everyone in the class? Right? So government can actually tax more. Government can actually tax more to make the aggregate demand break even, means at zero. So for net effect on aggregate demand to be zero, how much further can government increase the taxes? The government can increase the tax by a ratio of spending over MPC. So check here, if I put up this formula, let's say the spending was $100 and the MPC was 80. So what happens at 100 divided by 0.8? That is 125. So guys, if I increase the tax, if I charge the economy by tax of 125, and on that opposite side, the spending is 100. So 100 into 2.5, the aggregate demand will increase by 250, correct? And taxes into marginal propensity to consume into the multiplier, this will also become 250. Check it. 125 into 0.8 into 2.5, this will become 250. So basically the government very smartly here can actually spend $100 billion and collect $125 billion. Still the aggregate demand is balanced. But here, if the government charges little tax, less taxes compared to 125 is the maximum. Any amount government charging less than 125 will actually increase the GDP. Understood? So the shortcut for increase in tax, the maximum that the government can have tax is spending over MPC. That point, anything lesser than that, the economy will grow. Understood? Everyone, very critical. All the formulas that I've given, only keep that in your head. Okay, don't do anything extra. Now comes the discussion of Ricardian equivalence. What is Ricardian equivalence? Well, it's a point where David Ricardo mentioned that the government actually increases the spending or reduces the taxes, but investors are very smart. People are very smart. They think that the government, they think forward looking, means they see the government is currently reducing the tax. It means many people call the government is giving a lollipop. In the future, what will they do? Well, they are actually right now cutting the taxes so that in future they will probably charge higher taxes. So people do not take the tax cut by the government as a positive sign and start spending more. They don't spend more. Government actually wants that, see, I'm reducing the tax, I want you to spend more consumption, the economy will grow. But the reduction in current taxes don't make the consumers better off. Rather, they don't consume more, they rather save more, because they think in the future that tax liability will increase because the government will not walk the talk and it will find it difficult to do it forever. So therefore, if taxpayers reduce the current consumption and rather increase the savings, the effect in the economy that was supposed to happen will not happen. So to repay the, so if it just offsets enough to repay the principal and interest that the government has borrowed, then there is no effect on aggregate demand. So if people think that current taxes will lead to higher taxes in the future, tax cuts will lead to higher taxes in the future, what does the Ricardian equivalence says? That the effect, the government spending's effect in the economy will not happen. Understood? Consequently, private savings rises by the amount of public saving fall, leaving the national savings unchanged. This is called a Ricardian equivalence by David Ricardo. Okay. So people do not correctly anticipate all the future taxes. If they don't do that, then the economy will grow. But if they correctly anticipate that the current reduction in tax will increase to more taxes in the future, then there will be no effect in the economy. So what is Ricardian equivalence? That means government reducing taxes means government wants you to spend more. That will not happen because people are smarter and they think that there will be future taxes. So basically some of the taxing, some of the spending measures, some of the expansionary measures by the government are futile. They are useless. Understood? That is Ricardian equivalence. Rest of the thing you can just walk through. Overall, macroeconomic, what are the macroeconomic issues that may hinder the usefulness of fiscal policy? Means what will stop from fiscal policy being a successful? Number one, misreading the economic statistics. So if you are implementing fiscal policies by looking at the wrong indicators, then it will be rather counter-interactive, right? Crowding out effect, as I said, if most of the borrowing is taken by the government, very little will be left for the private sector. What if there are supply shortages in the world due to war and pandemic? And you cannot keep on increasing fiscal deficit forever. Many of the economists don't like it, and many of the countries have law, right? How much fiscal deficit maximum. In fact, Warren Buffett once said that the governments who are increasing their fiscal deficit about 3% of their GDP should be put behind bars. So this is what an extreme statement. So fiscal deficit has limitation. In many of the countries, it is legally limited. right? Otherwise, the government will just simply keep on borrowing and adding more burden to the next generation. Also, just controlling the fiscal deficit, the fiscal policy implementation has multiple goals: redistribution of wealth, increasing the GDP. All of these goals sometimes are counteractive, and they don't always support. You cannot always cover all the goals through one implementation. So these are the problems in implementation. And also fiscal deficit keeps on swinging with the business cycle. So instead of looking fiscal deficit at a particular point of time, some of the economists calculate something called a structural budget deficit or structural fiscal deficit, which is also called cyclically adjusted budget deficit. So instead of looking fiscal deficit at a specific point of time, we know the business cycles, each at different point of business cycle, there will be different fiscal deficit. So we look at something which is adjusted for the business cycles. So it is a deficit that would occur based on the current policies if the economy were at full employment. So it is adjusted for business cycle. That is called structural budget deficit or cyclically adjusted budget deficit. Let's do some of the questions based on this complicated reading. Okay. The government budget deficit of country M is increasing. So they are increasing budget deficit. Is it expansionary or contractionary? Expansionary, correct? They are increasing the budget deficit, means they are spending more. At the same time, government budget surplus of country N is decreasing. See, country N has a budget surplus, but that is decreasing. Can you tell me, is it expansionary or contractionary? Deficit increasing, expansionary. Surplus is reducing. Everyone, can I say even that is expansionary, isn't it? Surplus increasing means taxing more. Surplus is reducing. That means even that is expansionary. So are the fiscal policies of both the countries are expansionary? Everyone with me? B. See, surplus means taxes are more. So if that is reducing, government is spending more. Understood the terminology? Everyone? Both are expansionary. Clear? Everyone? Yes. Next, everyone please try. Which of the following statement about achieving proper timing in fiscal policy is least accurate? You're looking for the wrong answer. Improvements in quantitative methods will get me the information faster, have made the occurrence of recession or expansion quite predictable. Do you think expansion and contractions are easy to identify or easy to predict? No, they are difficult to predict. They are unpredictable. This is a wrong statement. Okay, the one which is wrong is this, but let's see B and C. Policy errors are inevitable due to unpredictable events. Correct. Policy can never be perfect. There is usually a time lag between when a change in policy is needed and when the need is recognized by the policymakers. Correct. There is an implementation lag. There is a recognition lag. So there's nothing wrong. So B and C are correct. We are looking for least accurate, the wrong statement. That is A. Nothing wrong with B and C. It's a lagging thing. So C is correct. Understood? The one which is wrong is A. Clear? And why it is wrong? Because cycles are not predictable. They are unpredictable. Crowding out, as I said, means government borrows so much that very little is left for the private, right? So budget deficit will increase the real interest rate and thereby retard private investment. Correct. Privates will find it difficult to borrow, isn't it? Let's see the other. Budget surplus will retard aggregate demand and trigger economic downturn. No, surplus will never lead the economy to downturn. Budget deficit will stimulate aggregate demand, correct, and trigger a multiplier effect which will lead to inflation. No, not necessarily. It will not necessarily lead to inflation. It will lead to increase in aggregate demand, correct, but not necessarily inflation. So the correct answer is crowding out. When they say about crowding out model, crowding out means there is very little left for the private investment. Crowding out talks about for private investment, not anything about inflation or something. Okay. Clear? Whenever you hear about crowding out effect means government borrowings or increasing of rates. See, when governments borrow more, rates will increase global because there's lack of funds and private will find it difficult to borrow. Got it? Question number 5. Are the statements made by Nico and Packard correct? So we'll see the statements. Both of these guys are research associates. ERA asks them something for opinions about the effect of fiscal policy on real GDP for economy currently experiencing a recession. Right? What is the statement? Nico states that real GDP is likely to increase. Real GDP means aggregate demand. If both government spending and taxes are increased by the same amount. Yes, we did understand that if the budget is balanced, the aggregate demand increases. That was the concept of balanced budget multiplier, right? So that is correct. Packard states that if both government spending and taxes are increased by the same amount, there is no expected real effect on GDP. So this is completely opposite statement. So either of the statement has to be right, right? So who has been correct here? Nico has been correct. Packard has been incorrect. The answer is A. Everyone correct, correct, correct. Perfect. Yes. An example of contractionary fiscal. See, first of all, fiscal policy means taxes and spending. Contractionary means the government is spending either less or taxes are more or both. Decrease in fiscal surplus, decrease in surplus means going towards more deficit, that is expansionary. Increasing in fiscal surplus, yes, that is contractionary because that means taxes will be more or spending will be less. That is contractionary. Understood, everyone? Clear? Right. Yes. That's the end of your fiscal policy. So fiscal policy and monetary policy are two related, but we covered fiscal policy first, and now we'll move to monetary policy. Understood till this point? Yes, I have a doubt on question number 2. What is the question number 2? Yes, please. Remember, in question number 2, you are looking for what? You're looking for wrong statement, right? What is the wrong statement here? Yes. First of all, is there a policy lag? Yes, there is a policy lag. So C was correct. Policy errors are inevitable due to unpredictable events. Correct. What was the problem with A? Improvements in quantity methods have made the occurrence of recession and expansions quite predictable. No, they both are unpredictable, right? Even if there are improvement in quantitative methods, events are unpredictable. So that word predictable is an issue. Got that doubt? Clear? Perfect. Yes. So we covered fiscal policy and now we'll move to monetary policy. Okay. Yes.